taking a look at the picture, we've got some easing back of the rand filtering through. So moving away from 4-month highs to 658.20 against the dollar that was hit yesterday. Is the rand's bullish trend still intact in your view?
Yeah, good morning, Alishia. Well, of course, like we indicated yesterday, it's very difficult to meaningfully assess whether or not the herd is still quite rand bullish because of the holiday interrupted trade, which is going to really persist up until Tuesday of next week. We are sitting in the camp of a weaker rand from current levels. We don't think the rand is likely to pierce the kind of lows that we saw in December last year. And you know, if it doesn't pierce that 655 level which you mentioned, then I think we could very well retreat back up to the 670 area over the coming weeks. So we'll be watching that, but again, we need to see more volumes coming through the market to meaningfully assess you know, the thinking in the market at this stage.
Of course, we've got that dollar index remaining the biggest driving factor at the moment. Are we simply looking at a weaker dollar for longer, given the Fed's comments this week? Because that will be a big contributing factor to the level at which the rand sits moving forward.
Yeah, well, sure, the dollar is weak, and it remains weak because of the accommodative stance from the Fed vis-a-vis the ECB, which is a lot more hawkish and has already, in fact, increased its interest rates. But I think, you know, we've got to always bear in mind that markets are forward-looking, and the Fed has indicated that it's going to roll out its quantitative easing measures up until the middle of this year. Thereafter, the people, you know, have to reassess the situation and start looking for when the Fed is probably going to start moving to a more normal stance, because at the moment, as we're saying, monetary policy is very accommodative. They're not likely to become a restrictive policy for the foreseeable future, but they could very well move into more neutral territory. And that would, of course, increase US interest rates and possibly the appeal of some of those pro-cyclical and high-yielding currencies, such as the rand. So I think we've got to, you know, look at the situation going forward rather than what's already priced in. I think the dollar is weak, and it's weak for good reason, but how much of that weakness is fully priced in with relation to the accommodative stance? I think quite a lot.
Despite being very accommodative over in the US, we've got growth having slowed in the first quarter, while we had data reveal yesterday that claims for unemployment benefits jumped to their highest level since January as well. What have you made of that latest batch of US economic data that's come through?
Well, obviously, the higher oil prices haven't helped the US recovery story. But, you know, I think, you know, although there are these kind of false starts here and there, I think broad-based, we're starting to see the unemployment rate in the US recede. And that's the key one really to look out for. The US Fed has to be mindful of the unemployment rate as well as inflation. And we've seen now that the Fed is coming under slowly but surely increasing pressure to be mindful of rising inflationary pressures at a time when unemployment now is starting to improve. If we see further improvement in unemployment, if we see inflation remain on the upward trend, then I think the Fed is going to have no choice but to start moving to a more neutral stance. And as a result, the markets will then start looking to price in those interest rate hikes out of the US. So that's the key thing to look out for. But I think on balance, the US economy is recovering. We mustn't just you know, take one quarter as an isolated incident, because we did see a lot of influence coming through from those high oil prices, which of course stemmed some of that growth.
Let's shift over to the east and take a look at some of the data that's filtered through from China. We had HSBC's PMI data come through and showing that it's clung to near 7-month lows in April, showing that output growth has cooled, but many saying no need to worry just yet. All this means is a more sustainable growth path moving forward. How have you read that which has come through from that end?
Yeah, look, I think China is also obviously a very interesting one to watch. We've seen phenomenal growth, and we are going to see these bouts of cooling. But I think, you know, we again are going to have to start seeing, you know, the central bank out of China continuing with its monetary tightening going forward, because that's the key. You don't want the economy to overheat. You want that sustained growth. And if things do get out of hand, we could very well see the need for more responsible monetary policy in order to avoid those bubbles from developing. And we see it obviously quite clearly in things like commodity prices, where we've seen commodity prices rally very, very strongly, partly as a result of very low interest rates, so there's a speculative element in there, but also because of this sensational demand out of China for raw materials. And if the economy fails to sustain that demand, then we are going to have to see more tightening coming through from that region as well. So I think the story going forward is one of higher rates and growing concerns about inflation. And I think with that backdrop, you can't still be bullish about the rand.
Of course, Michael, this comes as a precursor to our own PMI data, which is set for release next week, Tuesday. Your expectations on that front on home ground?
Yeah, the manufacturing sector in South Africa has been recovering quite nicely despite the strength in the currency. Obviously, companies as possible, and those dividends are coming through, and that's why we're seeing those recoveries. But of course, we need to see the global economy recovering on a sustained basis in order for us to sustain that recovery in the local manufacturing sector. So we expect the figure to come in once again above that critical 50-point mark, and let's hope that it surprises to the upside, because then it will suggest that South Africa's GDP growth rates that we've seen over the last quarter or two are going to continue to improve. Of course, that might then in turn lead to the need for more monetary or renewed monetary tightening from the SARB in the not too distant future.
Having said that, looking at data out today, we had economists polled by Reuters forecasting that private sector credit would expand by just over 6% year on year in March. That figures come in having slowed to 5.13%. How are you reading that? Because it does signal the health of the South African consumer in terms of what we're facing right now.
Correct. I think that's a very good indication, especially with in terms of the property market. What really dragged down credit extension was the housing component, and that's got a heavy weight in that private sector basket. And it just shows that the housing market in South Africa is by no means out of the woods as yet. And we need to see a greater improvement coming through in those sectors before we can honestly say that the consumer in South Africa has come back to the party. I think there is still a lot of deleveraging taking place. People are taking advantage of the low interest rate environment to cut back on some of those high debt levels that they incurred in previous years. So once that's out the way, we can then probably see the consumer coming back. But we are fairly constructive about the South African consumer because, he has been deleveraging for a while. We've seen some healthy increases in real wage over the past year. So we are expecting South African consumers to come back to some extent. And of course, that's going to be a key driver for growth going forward. Consumer spending traditionally makes up a large chunk of overall GDP. And if you couple that with government's ongoing desire to increase infrastructure projects, we could very well see growth surprising in South Africa to the upside. And again, feeding through possibly to the need for monetary tightening. Again, it's not really monetary tightening, it's more monetary normalization.